Financial independence doesn't happen overnight, but it also doesn't require complex trading strategies or speculative investments. The foundation of sustainable wealth building lies in understanding dividend-focused ETFs that can generate consistent income while preserving capital. Today, we'll examine 3 cornerstone ETFs that form what many consider the optimal perpetual dividend portfolio: SCHD, JEPI, and VYM. The perpetual dividend strategy centers on creating a portfolio that generates increasing income over time while maintaining the potential for capital appreciation. Unlike growth-focused investing, this approach prioritizes companies with proven track records of returning cash to shareholders through dividends. The goal isn't quick gains but sustainable, long-term wealth accumulation that can support retirement without depleting principal. This strategy works because dividend-paying companies typically demonstrate financial stability, mature business models, and consistent cash flow generation. By focusing on ETFs that hold baskets of these companies, investors achieve instant diversification while maintaining exposure to dividend growth potential. The Schwab U.S. Dividend Equity ETF, SCHD, represents the gold standard of dividend ETFs, focusing exclusively on high-quality U.S. companies with sustainable dividend policies. With an expense ratio of just 0.06%, SCHD tracks the Dow Jones U.S. Dividend 100 Index, which selects companies based on fundamental strength rather than simply highest yield. SCHD's methodology is sophisticated. It screens for companies with 10+ years of consecutive dividend payments, strong financial metrics including return on equity and debt-to-equity ratios, and excludes rights and utilities to maintain focus on diverse, high-quality businesses. The result is a portfolio of approximately 100 companies with an average dividend yield around 3.5%. The ETF's performance speaks volumes. Over the past decade, SCHD has delivered total returns exceeding 12% annually while maintaining dividend growth of approximately 8% per year. Major holdings include companies like Broadcom, Texas Instruments, and Cisco Systems, established technology and industrial leaders with proven cash generation capabilities. What makes SCHD particularly attractive is its balance between current income and growth potential. The companies held aren't mature utilities or consumer staples but dynamic businesses that can increase dividends over time. This provides natural inflation protection, as dividend growth typically outpaces inflation over extended periods. J.P. Morgan Equity Premium Income ETF, JEPI, takes a different approach to dividend generation through its unique covered call strategy. While traditional dividend ETFs rely on companies' dividend policies, JEPI creates additional income by selling call options on its equity holdings, resulting in monthly distributions that often exceed 8% annually. JEPI's portfolio consists of high-quality large-cap U.S. stocks similar to those found in the S&P 500, but the covered call overlay generates premium income that supplements traditional dividends. This strategy provides several advantages: monthly cash flow for retirees, reduced portfolio volatility due to the option premiums received, and exposure to quality companies with dividend growth potential. The monthly distribution schedule makes JEPI particularly appealing for retirees who need regular income. Instead of quarterly payments typical of most dividend stocks, JEPI provides predictable monthly cash flow that can be used for living expenses or reinvested for compounding growth. However, the covered call strategy does limit upside potential during strong bull markets. When stocks rise significantly above the call strike prices, JEPI must sell shares at predetermined levels, capping gains. This trade-off between higher current income and reduced capital appreciation potential makes JEPI ideal for investors prioritizing current income over maximum growth. Vanguard High Dividend Yield ETF, VYM, completes the trinity by providing broad exposure to dividend-paying companies across the entire market capitalization spectrum. With over 400 holdings and an ultra-low expense ratio of 0.06%, VYM tracks the FTSE High Dividend Yield Index, focusing on companies that pay above-average dividends. VYM's diversification is its greatest strength. The ETF holds companies across all sectors, from technology giants like Microsoft and Apple to healthcare leaders like Johnson & Johnson and financial powerhouses like JP Morgan Chase. This broad diversification reduces single company and sector-specific risks while maintaining exposure to dividend growth across the economy. The ETF's yield typically ranges between 2.5% and 3.5%, lower than SCHD or JEPI. But VYM compensates with superior diversification and potential for dividend growth. Many of VYM's holdings are dividend aristocrats or companies with long histories of dividend increases, providing inflation protection over time. VYM's market cap weighting means larger companies have greater influence on performance, but this also provides stability during market volatility. The combination of size, diversification, and dividend focus creates a core holding suitable for any long-term investor seeking reliable income. Combining these three ETFs creates a powerful dividend-focused portfolio with complementary strengths. A typical allocation might include 40% SCHD for quality and growth, 30% VYM for broad diversification, and 30% JEPI for current income and volatility reduction. This combination provides current yield around 4 to 5% while maintaining potential for dividend growth. The monthly distributions from JEPI complement quarterly payments from SCHD and VYM, creating more consistent cash flow throughout the year. The perpetual dividend strategy works because it focuses on companies and funds with proven track records of cash generation and shareholder returns. Unlike speculative investments that promise quick wealth, dividend ETFs provide predictable income that can grow over time while preserving capital. Success requires patience, consistency, and reinvestment during accumulation phases. By focusing on quality companies that pay sustainable dividends, investors build wealth through compounding returns while generating increasing income streams that can eventually support retirement without depleting principal. This approach isn't glamorous, but it's proven effective for building lasting wealth and achieving true financial independence.